Getting married is one of the most significant milestones in an individual's life. Despite less than half of the millennial generation being married at present, it's likely that most of us would someday like to be. But does tying the knot make financial sense? It's widely believed that marriage comes with great financial benefits, particularly in the tax department. And while this can be true, it's not as significant as you might think. So I thought I'd compile a list of all the financial benefits of being married so that you can decide whether he or she is really worth it. I'm kidding, don't get married for financial reasons alone. Let's start off with income tax by taking a look at what impact marriage has on the taxation of your employment income. The two things which are important here are tax bands and tax credits. Tax bands decide how much you can earn before having to pay a higher rate of tax, whereas tax credits are deductions which you're allowed to take from the tax you owe. We can see on Revenue's website that a single person working in 2022 can earn up to €36,800 while being taxed at the 20% rate of income tax. Any earnings over this amount will then be taxed at 40%. In other words, the first €36,800 of earnings will always be taxed at 20%, and every euro over that will always be taxed at 40%. Then we look at tax credits. If you're single in 2022, you'll be entitled to a single person's tax credit of €1,700. If you're employed, you'll also be entitled to the employee PAYE tax credit of €1,700. This brings the total tax credits for most single individuals to €3,400 each year. Again, this is €3,400 that you can deduct from your income tax liability. Don't worry, we'll be going through an example. Now, when you get married, Revenue will automatically place you under what's known as the joint assessment basis of taxation. When that happens, your tax bands and tax credits will change. Starting with tax bands, there's two potential circumstances which can arise. You can have a married couple where only one spouse is earning an income, represented by this box. And you can have a married couple where both spouses are earning an income, represented by this box. The most important thing to be aware of here is that a married couple can collectively earn up to €45,800 while being taxed at the 20% rate of income tax. That's €9,000 more than a single person. With that in mind, let's look at how this can translate into tax savings. Whenever you're trying to get a rough idea of your income tax liability, I highly recommend using the PwC tax calculator, which is what you're seeing on screen. I'll leave a link to that in the description. So in order to illustrate where the benefit of the married person's tax band comes into play, we're going to use 4 examples. And the reason why we're doing 4 examples is to show that the income tax benefits of marriage are only applicable in certain scenarios. In our first example, we have 2 individuals. One individual is earning a salary of €50,000 and the other individual isn't earning anything. They want to know whether the married person's tax band will save them any money. Let's take a look at their current situation before they get married. Only the individual earning €50,000 will be taxed. Because they're a single individual, we can see that the first €36,800 is being taxed at 20%, with the remaining €13,200 being taxed at 40%. This gives us a total income tax liability before tax credits of €12,640. Now let's take a look at what happens when they get married. This time, the first €45,800 is being taxed at 20% because they're a married couple, with the remaining €4,200 being taxed at 40%. This gives us a total income tax liability before tax credits of €10,840. That equates to a tax saving of €1,800 by choosing to get married. But where did that come from? As we established earlier, the married person's tax band for the 20% rate is €9,000 more than the single person's tax band. The tax saving associated with that isn't €9,000, but rather 20% of €9,000, which is €1,800. So we're saving tax by allowing the individual who is earning money to stay on the 20% rate for longer. In our second example, we have 2 individuals, one earning €50,000 and one earning €20,000. Again, let's start with their situation pre-marriage. Like before, the individual earning €50,000 ends up with a total income tax liability before tax credits of €12,640. The individual earning €20,000 is only taxed at 20% because they're earning below their single person's tax band of €36,800. This gives them a total income tax liability before tax credits of €4,000, meaning pre-marriage the couple have a total tax liability of €16,640 between them. This time, when the couple marry, the second tax band box will apply because both individuals are earning money. The long and short of this second tax band is revenue saying that the maximum amount of money that the couple can earn at the 20% tax rate collectively is the same as if they were both single individuals. €45,800 plus €27,800 is the exact same as €36,800 times 2. Revenue is also saying that the maximum amount that any one spouse can earn at the 20% tax rate is €45,800. Now, if that's confusing, don't worry, because all we care about is whether or not there's a tax saving. So, as we can see, the couple ends up with a total income tax liability before tax credits of €14,840. Once again, this is a tax saving of €1,800 for the exact same reason as the prior example. In our third example, both individuals are earning €50,000. As single individuals, both will end up with a total income tax liability before tax credits of €12,640, giving a total tax liability of €25,280 between them. Watch what happens when we tax as a married couple. The total tax liability between the two individuals taxed as a married couple is still €25,280, meaning there is no tax saving associated with being married in this instance. The reason why is because both individuals are earning more than €36,800, which is the 20% tax band. Similarly, in our fourth example, both individuals are earning €20,000. Both will end up with a total income tax liability before tax credits of €4,000, giving a total tax liability of €8,000 between them. Again, watch what happens when we tax as a married couple. The total tax liability between the two individuals taxed as a married couple is still €8,000. Once again, no tax saving associated with being married. But this time, the reason why is because neither of the individuals are earning more than €36,800. So we can summarize our findings as follows. Getting married is only beneficial for income tax purposes if A, only one spouse is earning money and that spouse is being taxed at the higher rate, or B, both spouses are earning money with only one spouse being taxed at the higher rate. It's also worthwhile noting that a tax refund can be awarded after the year of marriage if it's shown that you would have saved tax if you were treated as a married couple for that period. Then we have to look at the tax savings associated with being married from a tax credit perspective. We mentioned at the beginning that the total tax credits for most single individuals is €3,400 each year. When you get married, you become entitled to the married person's tax credit of €3,400, which is essentially both individuals' single person's tax credit combined. This is only valuable where one spouse is earning no income or isn't earning enough income to fully utilize their single person's tax credit of €1,700. Using our example from earlier of the single spouse earning €50,000, we can see that as an individual, they only have tax credits of €3,400, which is the single person's tax credit of €1,700 plus the employee PAYE tax credit of €1,700. However, once the two individuals marry, the tax credits increase to €5,100, and that's because the spouse earning the money is now effectively entitled to the unused tax credit of the other spouse. Another tax credit which will be of interest to married couples, specifically where one spouse is earning little to no income, is the home cares tax credit of €1,600. Outside of income tax, there are other tax benefits associated with being married. The first benefit will be in respect of gifts and inheritances, which are covered by capital acquisitions tax. As single individuals, the tax law permits gifts to the value of €3,000 to be made tax-free each year to one another. Outside of that, any gifts exceeding €3,000 will be taxable at 33% under capital acquisitions tax. However, each individual will have a lifetime threshold of €16,250 in respect of gifts and inheritances received from a stranger, which couples are in the eyes of the tax law. When you get married, things become a lot simpler. Gifts and inheritances between spouses are fully exempt from capital acquisitions tax. End of story. This is obviously extremely beneficial if you plan on gifting or bequeathing valuable assets to your partner. Likewise, transfers of assets between spouses are also exempt from capital gains tax, which isn't the case for non-married individuals. Stamp duty tax will also not be applicable to transfers between spouses. So clearly lots of valuable exemptions there, especially when we consider the likes of life assurance payouts, which will be exempt from capital acquisitions tax provided the couple are married. Marriage also comes with protective rights. For example, under the Successions Act of 1965, if a spouse dies without a will and there's no children, then the other spouse will receive the entire estate. If there are children, the spouse receives 66% of the estate and the remainder is distributed equally among the children. More importantly, if there is a will and the surviving spouse feels they haven't been rightly provided for, they can elect to receive up to 50% of the estate as their legal share. It's important to be aware that co-habitants, that is, individuals who live together but aren't married, do have certain rights, which you should definitely be aware of. Check out the link in the description to learn more. Marriage is also great for retirement benefits. For example, the state offers a widow's and widower's pension for surviving spouses who meet the necessary criteria. Some companies also offer death and service benefits, which will be paid out to surviving spouses in addition to the value of the pension, which has been accumulated up to the date of death. Pension benefits can also be transferred to an approved retirement fund in the name of the surviving spouse upon death, without any tax implications. Essentially, lots of great reasons to be married from a retirement perspective. So, does marriage make financial sense? Absolutely. The rules governing our society are very much set up to encourage marriage. Obviously, not all marriages end well, and when legal teams and various court orders start getting involved, the financial benefits of marriage can quickly turn sour. So while it might be in your best financial interests, it's probably not wise to enter a marriage on that basis alone. If you can think of any other financial benefits associated with being married that I missed, just leave them in the comment section. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.